As I said, we will cover the topics of the stock market today: equity, their valuation, how people take the position in the stock and equity markets. Maybe you know we are differentiating the market condition according to their return and their risk. If the risk is low, for instance, if you are trying to take a position in the capital market, lots of intermediary institutions asking you about the question is, how is your risk appetite? What is your risk outlook? And the first question is, are you risk aversive or risk lowering? If you are risk aversive, they are saying that you shouldn't take the position in stock market exchange, because the people who have lower risk appetite, who are liking the low risk, they are taking generally position in the fixed income securities like government bonds, treasury yields, term deposit. There is no risk in those assets, because if you take a term deposit for 1 year and if you put $1 million, the banks will assure to you that with the 3.5%, let's say, at the end of the year, you will get $38,000 for your $1 million at the end of the year without no risk. This is fixed income. And because you don't lower the risk, you will get this amount of money at the end of the year with the 100% probability. Okay, no risk. But as you know, we have lots of stock exchange around the world. In the United States, Dow, Nasdaq, and S&P 500. For instance, in United Kingdom, we have Russell. We have in the Germany, we have DAX index. All over the world, in all countries, we have the stock market exchange. And we have lots of firms in those stock exchange. They are taking the position, like Amazon, like Alibaba, like Intel, like corporate exchange. Everything is taking a valuation in those stock exchange and taking the value according to their valuation. So today we will try to cover those issues in stock market exchange. As you see here, we have two charts on the left-hand side and the right-hand side. The title, as you see, the corporate earnings and the sources of earning growth. And on the left-hand side, from the 1988 till now, approximately we have here 44 years. And the blue line showing the consensus analyst estimate for the index annual operating earnings. As you see, the title for this S&P 500 earning per share. What does this mean? You have, let's say, Intel Corporation. The Intel today taking evaluation in Nasdaq around $33. If you get, let's say, $202 at the end of the year, earning per share for this stock is $2. So all pool indexes for S&P 500 earning per share, index annual operating earnings, and the unit is USD, is around, as you see, always in the upside. We will mention the topics of the dividend yield as well, but for now, you should know the earning per share, how the people earning money according to their position in the stock exchange. You should understand this topic first. And this, the dark green line, as you see here, the dark green line is the earning recession. What does this mean? We have earning, but negative. We are losing the money. And these are the dark green line. As you see here, we have 3 years during the global financial crisis. As you hear, you see that the Federal Reserve reverse repo operation. And as you see here, two line, the dark green line, these are the periods for the COVID-19 periods. During the COVID-19 periods, companies don't have the revenue at the end of the year. They get lost in their position. For that reason, we are saying that earning recession. But if it is positive, we have earning per share positive yields. On the right-hand side, as you see, S&P 500 year-over-year operating earning per share growth. What does this mean? You have money, but not the amount, but the year-over-year growth is important for us as investors, because every year a company can offer you $100, but earning per share growth for that investment is just zero, because there is no growth. You are getting every year the same amount. For that reason, the growth for earning per share is so important, because you will have at the end a growing asset in your package for the long term. And this is annual growth broken into revenue, changes in profit margin, and changes in share count. And look at this chart, please. This side, share of EPS growth, earning per share growth, 2023 margin is 8.1%, and the revenue is 2.4%. The share count is just 0.2%. Total earning per share is around 10.8%, around 11%. This is a good investment, because at the end of the year, you will get for $1 million around $110,000 at the end of the year, because of your investment earning per share. And what is important here, this side, because you can make an investment at 2,000, but this investment can get a negative return or below average return for you. But as you see, for the average return for 2001 and 22, approximately 22 years, the average total EPS is around 8.4%. But for this year just now, you can have additional 2.5% earning per share for your investment. For that reason, your investment is a good choice if you take a position in S&P 500 for your return, overall return. The main argument, what is triggering, and what is the fundamentals that take the main function in the valuation of the stock exchange? Those are the company's outlooks, trade balance, cash balance, balance sheet, income statement. Those are the main items. But what are the triggering points in the financial market for your investment position? Hang on a sec. As you know, the interest rate cut and rate hike in the international financial market can directly affect your position in the stock exchange. Why? We should ask this question. Always, while taking a position, you should ask yourself, the question is, why the interest rate probability, rate cut or rate hike, can affect my position in stock exchange? The main argument is this. Let's say we have one investor, okay, and he can put his money in the stock exchange or in the fixed income, like term deposit or fixed income securities like government bonds or treasuries. And let's say this guy don't want to put all the eggs in the same basket. He don't want to take the all risk. He is dividing his position. Let's say 50% position in the stock exchange and 50% position in the term deposit and fixed income securities. Okay, these are two divisions of their investment. One guy, he has $1 million. He has 50%, approximately $500,000 in stock exchange and 500,000 in the fixed income securities. And he know at the end of the year for $500,000 what he gets, but he don't know what he will get at the end of the year for the stock exchange, $500,000. And if the Fed interest rate rise, okay, if the Fed interest rate rise, this interest rate probability and policy rate will affect the bank loan and deposit rate in the financial market, because Fed is the highest authority who is giving the liquidity in the market and who is affecting the overall exchange rate, overall interest rate, and their action as monetary policy will directly affect loan spreads, credit spreads, and deposit spreads. For that reason, if the Fed increase the interest rate, this will trigger the interest rate hike in the financial market deposit banks. For that reason, the investor will think that at the first, I'm getting 3.5% at the end of the year, but right now, my bank's offering me 5%. So let's decrease the risky asset and let's increase the fixed income term deposit asset, because my return will be at the end of the year now 5%. At the initial, it is 3.5% before the interest rate hike. But right now, when I'm getting 5% without no risk, I will decrease my stock exchange risk asset position, and I'm increasing my fixed income securities and no risky asset position. So any interest rate hike from any central bank, it can be the Bank of Japan, Bank of England, European Central Bank, or it can be Federal Reserve. Whatever it is, any interest rate hike in the financial market from the central bank will decrease the risk appetite, will trigger the capital outflow from emerging market, and will decrease the asset valuation in the stock exchange. For that reason, you should first get this idea. Why the interest rate hike can decrease my investment position in the stock exchange? Because lots of people take their money from the stock exchange and put their money into the fixed income securities. And because they sell their stocks in the exchange market, the price will decrease and you will get lost. Okay, this is the main idea. And as you see here, this is the Fed interest rate probability and map. As you see, this is the line showing the Federal Reserve policy rate. And during the global financial market crisis, it is around the zero lower bound. And then with the quantitative tapering, this is the quantitative easing period. This 3 years, this 4 years, quantitative easing period. And here, Fed started to reverse repo operation, take their money from the market and give the securities to the banks and governments again. For that reason, this is the quantitative tapering period. This is the valuation, who is decreasing the revenue in the market, who is increasing the dollar spot exchange. This is quantitative tapering period. And here, this 2 years period, we have the COVID shock, like the financial market crisis. They are same. So the zero lower bound for the United States Federal Open Market Committee started again. What makes the difference? The first one, the global financial crisis, as you know from the name, it's a financial crisis. But the COVID shock is a real market crisis. But the response is same. You are decreasing the interest rate to the zero lower bound, and you are starting to increase your balance sheet. You are starting to take lots of government securities, asset-backed securities, mortgage-backed securities from the market, and you are giving excessive amount of dollar with cheaper cost, lower cost. For that reason, during this period, you have lots of money. You can put the position in the financial market. But right now, as you see, the Federal Open Market Committee policy rate is around 5.5%. It is around 6%. But at the end of the 2025, the global heating map showing us that the main probability will decrease 3.4% right now, and in the long run, the Fed target rate is 2.5%. Why? Because Fed, in the main title, the Fed has the price stability and the financial stability target. For that reason, to maintain their price stability, they will decrease the inflation. And to decrease the inflation, they should increase the interest rate. But as you know, the inflation heat map as well, during the COVID crisis, the inflation rise around 8% in the United States, but right now it's around, even for the core CPI, core consumer price index, it is around 3.5%. And for that reason, the inflation decreased from 7% to 3.5%, and the United States Federal Open Market Committee decreasing their interest rate accordingly the changes in the inflation output. And Fed in the long run has a long-term target, 2% inflation and 2% interest rate. And the interest rate will converge its long-run target as of, I think, 2025. This is the graph about the global economic activity momentum, and you should understand what this Purchasing Manager Index, PMI. Lots of times people hear about in CNBC or Bloomberg about the PMI, Purchasing Manager Index. And what does it mean? This is directly the operating and real market indicators for the sales, for the orders, any type of things. For instance, you are a factory owner. You are taking order from the rest of the world, from any continents, and for the next couple of months, you have lots of orders with the rest of the world, and they are asking you when they are making the survey. The question is this: what is your expectation for the next 3 months about your sales? And you are answering this: my sales is increasing 5% because I have orders 5% higher to the rest of the world. And this is directly a real market indicator. This is not a global financial market indicator. This is not stock exchange. This is not the XY. This is not S&P. This is not valuation. This is directly kitchen, what you are producing and what you are preparing in the kitchen. As you see, these are the developed economies, developed market: US, Japan, United Kingdom, Euro area, Germany, France, Italy, and Spain. An emerging market, the main indicator for the China, India, and Brazil. And for the PMI indicator, you should know that if the value is above the 50 level, this is the threshold level, whether there is a contraction or whether there is an increasing in your sales, in your operating profit, and etc. For that reason, if the value is above the 50, this is a good indicator about the market is operating in a good side. But if the PMI decreasing the 50 threshold level below, you can understand that something is wrong in the real market. And as you see, the manufacturing, by the way, we have two types of PMI indicators. We have PMI in manufacturing and services. And manufacturing is directly what we are producing, and services indicators, even the prices and production in the restaurants, even in the tourism activities or hotels. This is the services PMI, and this is the manufacturing PMI. And manufacturing PMI, as you see, is contracting. What I said a few minutes ago, the 50 threshold level is a good indicator for us what is happening in the manufacturing market. And the 50 level, the manufacturing PMI is below the 50 level. And this is saying that the real market production is contracting. Lots of factory is producing less than their average for the last, let's say, 10 or 20 years. But the services PMI is increasing. Why? A fifth class and training course ago, I mentioned that we have lots of indicators about the inflation contribution. We have contribution for the inflation from food, energy, shelter, composite indexes, and the services indexes. And as you know, the contribution from the food and services energy market will decreasing for the inflation. It is around 3% when the Russia and Ukraine war started in 2022. But right now, the energy market contribution for the inflation just around 0.5%. Or food as well. Because of the supply chain blockage during the COVID crisis, they are decreasing still. But what is the problem in inflation? The services market. What is the triggering point for the services market increasing PMI and cost? It is the wage. Because of the inflation, lots of people around the world, even people, professors at the university, even the services guys in the restaurant, all demand, all request the increase in their wage to compensate the inflation cost. Because you have $1,000, but you have huge inflation and your purchasing power parity is decreasing. For that reason, you want an increase in your wage. And this is the services PMI. For that reason, services sector will be strong and robust. Even solvency will be low in those sectors because of the wage sticky prices. For instance, if you have banana this year $10, banana cost can be next year $8, and you can take the banana, same banana, with the lower $2 less in the market, but the wage never decreased. Okay, normally never decreased. Nominally increased, maybe it can be decreased in real effect because of the inflation, but nominally wage will be sticky, and this will be really feeding the services sector PMI and the dollar drivers, because the best well-known currency all around the world, the dollar index, as you know, which is creating the risk appetite, the stock market exchange, Chicago board option volatility, all those type of things coming from the dollar drivers. And on the left-hand side, you have the United States dollar index. This is DXY. Okay, let me share my screen to make your understanding better. Okay, because lots of people couldn't understand those type of things. Let me open my Bloomberg, and you will understand what is the XY and what does it mean. It is around, it is about 100 or it is less than 100. You should understand that topic as well. I'm opening. Hang on a sec. Give me 1 second. People see my Bloomberg screen, right? If you see my Bloomberg screen, you can shake your head. Okay. This is my Bloomberg screen, and I will show you what does it mean when we are saying the DXY. Look at this, dollar spot exchange. As you see, this is DXY, US dollar spot currency. And let's look at the description. And here you will see the US dollar index, the DXY, indicates the general international value of the USD dollar. The United States dollar index does this by averaging the exchange rate between the USD and the major world currency. And the IC US computes this by using the interest rate supplied by 500 banks. What I want to show you about the dollar stock exchange, the XY, because you should know how the basket in dollar spot exchange can be adjusted. Look at this. And where is it? Hang on a sec. I wanna look at the basket weightings for the DXY, and you will see how the DXY can change according to that position. Here we are. As you see on the direct screen, what we have, the XY, the dollar spot exchange, as you see here, and we have 6 reserve currency all around the world. This is United Eurozone, Euro, Japanese yen, Great British Pound, Canadian dollar, Swedish krona, and Swiss franc. And these are the weighting for the United States DXY currency. Approximately 57% is coming from the euro, 13% coming from the Japanese yen, and 11% coming from the Great British Pound, and 10% and 9% coming from the Canadian dollar. What does this mean? This is a basket for 100. And let's look at this chart for this currency. And this means that if this value is above the 100 level, all the currencies around the world depreciating against the United States dollar. And if the dollar spot exchange decreasing, all the currency, even emerging market, even developing market, and even developed market, currencies taking value, appreciating against the United States dollar. So let me stop the screen and let me share my main slides again. We are here. This is USD dollar spot exchange. Okay, what I showed you a few minutes ago. And the United States dollar around 2000, approximately 23 years ago, this is the value for the dollar spot exchange, and it reached 120. What does this mean? Euro depreciate approximately. Euro depreciate the approximately 20% against the United States dollar. But during the crisis, during the global financial crisis, the euro appreciate approximately 25% against the United States dollar. And for now, this means that the United States dollar has a fair value around 100, and the world currencies is coming from the appreciation side. And the US trade balance, the current account balance as a percentage of GDP, what does this mean? The current account balance saying that we have goods and services balance, goods balance coming from the trade side, and services balance coming from the tourism activity, visiting, and those type of things. And the United States has a current account deficit, approximately 3% of their GDP. And this is huge. What does this mean? You should either have the goods market trade balance deficit, which means that you are exporting less than you are importing. So you have a current account deficit. And the developed market interest rate differentials. These are the dollar drivers. And difference between United States and international 10-year treasury yields. And this is showing that United States interest rate is higher than 1.6% on the June 30. And this is gaining the strength for the United States dollar. You should keep in mind that if your interest rate is high, your currency will be higher value because of your interest rate high, higher interest rate, lots of capital inflow coming to your country, and your country's currency gaining appreciation against those type of other currencies, rest of the world. And this is the valuation monitor. We have treasuries, US core bonds, developing market equity excluding United States, developed market equity excluding United States, emerging market equity. This is United States small market capitalization, and the United States value, high yield, large capital, and US growth. And as you see, asset class valuation, we have, as you see, current one is this one, and the 2021 is this. So we have this score in all over the valuation, in all over the investment assets and the tools, we have less than as we compared to the 2021. What does this mean? We are in cheaper side. So if you want to take a position in investment in stock exchange, it can be a good sign because it is cheaper, not so expensive. And the main charts, the consumer confidence for us and the stock market, this is showing the cyclicality for approximately 63 years. Okay, from 1970 till now, approximately 60 years, we have average subsequent 12-month S&P 500 returns, and this is 9 sentiment peak, 3.5%, and a 9 sentiment toes, it is 24%. It is huge. And you should look at this peak and bottom line. As you see here, 1990 is the Gulf crisis. This is 1975 oil crisis. And this is global financial crisis. And this is the COVID crisis. As you see, in any type of crisis, we have a really decreasing and contraction in consumer sentiment. And we have, if after the crisis, we have a real rebound and the recovery process because of the bailout from the central banks and governments for the monetary and fiscal policy. You should keep in mind this. The crisis period has the best period to take the position in stock market exchange. Why? Because lots of things will be cheaper. So if you are entering a recession period and the crisis period, if you have a cash at your hand, this is the best thing because you can take the position with your cash. But if you catch the crisis with the position in investment, this will be a little bit disgusting because your money will be losing, but you don't have any cash to put any additional position. And I'm going to show some additional charts to give you the correct investment position, how your money get huge investment in the stock exchange if you take position in the long run, not the short run. Okay, look at the position here. This is Australian Stock Exchange price indices, and this is the indexes for all ordinaries. This is this blue line. This orange line is industrial sectors, and the green line is the resources sector. So we are taking 3 sectors, and we are asking this question to ourselves. If I take the position here, December 1979, with the $100,000, and if I don't touch my money, don't touch, okay? Don't touch. I am putting to these sectors $100,000 in December 1979, and I'm not touching the money. What will be have for my money after the 45 years? And the answer for this question in resources sectors, your 100,000 will be 1.1 million in the resources sector. If you put your money in all ordinaries, your 100,000 will be $1.5 million. But if you put it in the industrial sectors, your $100,000 will be valued around $2 million, meaning that 20 times higher your initial position. This is the answer if you are take a position for different sectors and if you don't touch your money. And let's take any other things, because if you are an investor, you should take the position with dividend yields in the long run. Look at this chart now. This is the chart if you don't touch your money. And this is the question now. I'm taking position in the same date, December 1997, and I have $100,000 at my hand again at the initial point. But every year, as I get the dividend, because every company pay you a dividend at the end of the year, because you are an investor, they have the revenue and the profit, and you will get your part from that profit. This is your dividend yield, okay? And if you put that dividend yield again to the same index, what will be have your money if you have 100,000 at the beginning? It will be $4.7 million in the resources index. It will be $8.5 million in the all ordinaries index, and it will be $15 million. Just think this, you have 100,000 and you are putting every profit that you get from the firm again to the same firm. This is your dividend, and your money will be increased from 100,000 to $15 million. Okay, look at the huge difference. And this is the volatility. And the volatility in these sectors, because we have resources, we have industries and all ordinaries, resources sectors are sensitive to business cycle, economic sentiment, because we have in the resources energy prices and those type of things. The resources volatility is a little bit higher. But what you should know that, look at this graph. This graph will explain everything to you. You have $100,000, okay, at the beginning, just $100,000 at the beginning. You are putting your money to the industrial sectors for 45 years. And you are not touching your money. This will be 2 million. But in every year, if you get the dividend yield and put the same index, it will be 15 million. Huge. Okay, so putting and taking a position in stock market exchange, not just going to a casino and play a gamble. Okay, you are an investor, you are not playing a gamble. You should take long run position and you should put your dividends in the same index in the long run perspective. And when you retire, your just 100,000 will be the $15 million. This is approximately 150 times higher for your initial investment. This is a huge. And the same story here again. If you put your money in resources sectors, $100,000, and if you don't touch your money, it will be $1.1 million. But if you put your dividend yield in the same resources index, it will be $4.6 million at the end of 2025. So you are putting money and you are getting approximately 40 times higher with your initial investment. So if you have 45 years and if your money growing 40 times higher each year, if you take average, approximately it is coupling, it is doubling in each year. Okay, this is a huge investment if you take the position in the long run. But what is the main story in this? Look at this graph. You are taking position in 1970s, 1980s, and until 2000, your money, your 100,000 is just around $300,000. But the main power of compounding after these 20 years. Here we have 20 years, it is just 2 times higher. But here we have again 20 years, it is approximately 40 times higher. So investment is not a playing game. Investment is a long-term perspective, and investment, if you take the position in stock market, you should put your dividend yield, your investment side as well. And last thing I want to mention, this is the best graph that I taking from the financial market condition, because lots of people asking about this question, how we take the position in the financial market indicators if we have commodity and equity. Okay, this is the main question. And the main problem is this. We have the commodity equity ratio approximately 50 years. And if the commodity equity ratio will peak, we have in crisis period. As you see here in oil crisis, as you see here in gold crisis, as you see here in the information technology bubble, as you see here, the global financial crisis, and as you see here, we have the COVID crisis. The commodity equity ratio is peak, we will have the crisis period. But right now, for the 50 years average, for the commodity equity ratio, we will have 3.4. It is around 4. So the current value is 0.8. What does this mean? This means this. Either the commodity is cheaper or the stock exchange, the equity is really expensive. This is the basic answer, because otherwise we will get this. We will have this. If I have a commodity equity ratio for the average, for the long run perspective, either I will have to take the position in energy prices, palladium, aluminum, coal, iron ore, or those type of things, or I will take a position in stock exchange for the firms. Okay, because we have safe asset, have an asset like gold, palladium, those type of commodities in the market, or I have a little bit volatile assets, the company's firm sector position, and they have a cyclicality, as you see in the graph. We have a cyclicality for those type of things. And what is my main issue here? If I have in the crisis period, commodity prices are expensive and equity prices is cheap. But right now, as you see here, the current value is 0.8. This means that I have either expensive equity or really cheaper commodity in the market. So if you want to take a position in commodity, this is the good period. Okay, for the commodity side, we have a good period to take a position or to make a profit realization. Stock exchange side, it can be a good sign as well, because their valuation, their price earning, their margins, their profits are a little bit expensive side. Okay, so let me end up my presentation, because I want to answer your old question today, because this is a good topic and interesting topic for the investors, who lots of people who are trying to take a position in financial market and money market. And if you have any question in charts, their position, their titles, I want to answer all those questions detailed.
Thank you, Dogan. If anyone has a question, you can use the hand reaction to raise the question or leave a comment in the chat. See, we have a question from Ike. Let's see what he has to say.
Yes, good afternoon, everybody. I hope you are hearing me clearly.
Yes, I'm hearing.
Okay. I'm speaking from Nigeria. Let me talk out of experience here. I have been in the Forex markets where I see all these indicators. You try to follow them in actually to pick when to buy and when to sell. But from my past experience, I think I have been failing it. And now that I'm here, you are teaching this. Please, I want you to elaborate more on these indicators, because you try as much as you can to be careful, to follow the trend of the indicators, when to purchase your shares and when to sell. So please, can you enlighten me a little on how to follow the indicators to actually follow the trend of the market? Thank you.
Okay. This is a good question. This is a really good question, because we should understand the currency rate markets and their stock exchange, foreign exchange market. And let me share my screen for your question. Okay, from the Bloomberg. And this is the Bloomberg. And I took the foreign exchange market here. This is the living data, as you see. Okay, we are living data. And as you see here, the United States dollar, and here we can change the stock. Let's take the spot market, not the forward market or fixing. And we can ask the question, what does $1 or €1 here means? And let's say Euro USD parity. Okay, this is a 111. Or let's say GBP USD parity, it is 125. Or let's say out USD parity, it is 0.67. And in the Forex market, if I take the arbitrage condition on this, I can take stop loss. But the main triggering point for the long run perspective, or at least the mid-run perspective, is this. The United States start to increase their, let's look at the Euro USD parity, and you can understand my concern easily. And let's look at this during the COVID crisis. Okay. As you see, this chart is showing the euro performance against the United States dollar. During the COVID crisis, as you see, Euro USD parity we have here, it decreased from 1.20 to till the below of the 1. What does this mean? Euro depreciate approximately 20% against the United States dollar. But what does this mean? What is the main point behind this? Because the United States Federal Open Market Committee started to decrease their interest rate first, then they take the position after the inflation decreasing, they increase their interest rate so speedy. So the euro interest rate will be here and the United States interest rate here, because they start initially at this point and the USD interest rate now here, rate hike, Federal Open Market Committee, but ECB is here. Now we know that the Fed interest rate hike process will be end. And for that reason, during this period, the euro will depreciate, but now they started to appreciate, as you see in the graph here. Okay, as you see in the graph here, the euro started to appreciating period and it break the support region in 110 and it will converge around 120 because the rate hike process will end for the FOMC, but it is starting and it will converge and it will continue for the ECB. For that reason, the major currencies all around them, this can be Swedish krona, this can be Australian dollar, this can be Canadian dollar or Great British pound, they will get strength against US dollar. So it is the good time to short the USD and to long the rest of the world. Okay?
Okay, thank you.
Thank you. Since we have another question from Obafemi, let's see what he has to say.
Yeah, good afternoon. Good afternoon.
Good afternoon.
Yeah, I thank you very much for the presentation and the enlightening and insightful information we got. I just wanted to ask, I don't have as much as $100,000 talking about investment, but there was a time I had a little sum like $1,000 and some, about $1,000, and I was looking at what's the best investment that this money can be put into. And I just couldn't locate the best way to get this money invested. My question is, if you have such money, where exactly can you put it for good reward, for good returns and profits? So that's my question to our speaker. Thank you.
Actually, as I said, the main problem is this. First, while taking the position, all investors should ask, while taking position in investment, this question. Am I a risk appetite person, risk-taking position? My risk position is high or low? If you don't like risk, you shouldn't go enter the position in stock exchange. You should take the position in fixed income. You should take the position in term deposit. You will get assured money at the end of the year, and you will not take any additional position. But if you put your $100,000 at the beginning of the year, and you will end the year with the 50,000 loss as well. This is the probability, because in stock market exchange, we have two probabilities. It can be increase or decrease, but no assured. Okay, your amount of money can be doubled at the end of the year, but you can even lose 80% of your money at the end of the year. For that reason, not the stock market, not the valuation market, not the Forex market, not the cryptocurrency market. The main question is this: am I like risk or not? If I like risk, how much? If I like hugely, I can take a position in Forex. If I like the risk, but I'm lowering the risk less than the other people, so I will take the position in stock market. But if my answer for the am I right, the risk is no, I shouldn't take any position in crypto market, in Forex market, in stock exchange market, in valuation market. I will take the position in the fixed income securities and the interest rate side.
Thank you very much. Thank you.
We have two more questions. Let's see what Dr. Jane has to say.
Oh, good afternoon.
Good afternoon.
This is Jane talking from Nigeria. In respect to the stock exchange, my country, Nigeria, is an oil producing country. Now, due to economy, we don't have refineries that refine our crude oil. In this system, our crude oil is carried out to other countries to refine, then bring it back to Nigeria before the sales. Now, as an oil producing country, we in Nigeria don't even enjoy the dividends of oil producing country. Now, and you're telling us about corporate earning and source of earning. This is our source of earning, oil. And now the corporate earning is not coming forth because of exportation of our crude oil and refining it elsewhere, which is the cost, and the cost of bringing it down for the use in the country. So how do we manage this while we have such a problem in respect to stock market exchange?
Actually, this is a good question again. This is a commodity market, the oil market question. I can answer this type of question in this style. You can think, first of all, that what will be the main risk for the next couple of weeks, months, or the years for the oil market and energy market. As you know, when the Russian and Ukraine crisis started in 2021, they started to cut the supply of the oil to the rest of the world. Actually, not they cut, but they have lots of sanctions from the United States, and Russian oil supply chain to the rest of the world will be cut. And they have also cut their linkages to the rest of the world about the balance of payments, SWIFT payments as well. For that reason, if you are taking in energy market position, and if you are trying to take the dividend yield for the rest of the world for energy market, I can offer this, and I can say this. The oil market is a little bit more volatile and more sensitive to the economic cycle and business condition in the economic indicators. For instance, if you take a position in the let's say Murphy Oil in Nasdaq or New York Stock Exchange, and if you take a position in, let's say, Amazon earning per share, Amazon performance, and those type of things will be smooth and less sensitive to any type of negative shocks in the financial market. But the oil market and energy crisis will be really sensitive. If the Putin go to the television and say one word, your investment, your equity prices will be down 5% in a day, just because of a word, because they are sensitive. For that reason, you should be a little bit more careful about to take a position in commodity market, because commodity market is volatile and really sensitive to the economic condition and business cycle. I think two more people have question there.
Let's go to Hagos.
Yes, thank you, Dr. Wanda. My question, can you hear me well?
Actually, I couldn't get your voice. You can write in the chat your question as well.
Yeah, let me speak a bit louder. Can you hear me now? Can you hear me now?
Yes.
Okay, thank you. So my question is related to real estate investment, like purchasing property, comparing to the interest rate increase for example, in the United States, the reserve interest is increasing from time to time, and then the value of properties like housing is getting a bit lower than before. So is it just the right time to purchase a property when the interest rate is high, or when the interest is lower as compared to the property value, considering the market situation? Thank you.
Thanks a lot. This is a good question because, as you know, in all around the world, because of the interest rate hike, we are thinking about the mortgage market, right? Property market and mortgage market. I make 6 months valuation for the United States, one of the retail firms, to make the valuation. And after the rate hike, they stop their operation because if you have lower interest rate and mortgage loan rate in the market, lots of people go to the banks, take the loan, and take the position in property market with a cheaper cost, and their property price will increase because everybody increase their demand and price is going up. But right now, the cost of the mortgage is really high. So the cost will trigger the decrease in the prices of the retails, those houses, mortgages. But the main problem is if you want to buy the position in property market right now, your cost will be higher as well. The price of the house will be decreased, but you will pay at the end of the 10 years or 20 years mortgage loan periods, you will be pay higher cost because it's approximately 2% up 3 years ago, but right now it's around 5 and 6% for the mortgage market. So if you know the rate hike process will end at the end of this year, you should have your cash at your pocket, not the loan, because even the house price will decrease, your cost for the mortgage loan will increase because of the interest rate hike. So the cheaper house will be meaningless for you because you don't have enough cash, and you will go to the bank and you will get loan, and that will be higher cost as well. So the main problem is cash. Okay, you should be cash as amount, huge amount at your hand to benefit from this situation, not the loan.
Good morning. Dogan, can you hear me?
Yes, I'm hearing you. I think this was the last question. I'm taking question. Yes.
Okay. Oh, thank you so much for your presentation. But I just want to ask you about that. You're talking about stock exchange. Yeah. So like the countries that have minerals, like let's say like DRC got more potential minerals in their country. Can they also is it possible to keep like golds and diamonds like in the central bank to keep it like a stock exchange, to keep it so that the currency cannot weaken to the dollars, or what's happening there? How can it work?
Okay, let me explain from the Central Bank of Turkey, because I'm living in Turkey. If you have a central bank and if you have reserve, because all countries, if your money is not a reserve currency, for instance, lots of people is joining from Nigeria, and your country's currency, Nigeria currency, is not a reserve currency in the market. Hang on a second.
Okay, we'll wait for a second. Remember, after this class, I'm Dr. Lambert, and I will be here for a while to answer any of your questions about courses, academic issues, credits, how to choose courses. Okay, let's get back to the presentation.
As I said, from the central bank perspective, we have this issue. If you are in Nigeria and if your country's currency is not reserve currency, you should put enough gold and United States dollar or any other reserve currency like euro, like Canadian dollar in your central bank. Because if the rest of the world cut any condition, cut any trade balance with you, So you should have enough money to pay your imports, because you are importing lots of product to be live, to be sustainable, to proceed your operation, to proceed your factory. So you need enough money in your pocket, but your Nigerian currency are not accepted for the rest of the world. Okay, you can't pay the money with the Nigerian currency. Okay, for that reason, you should, and there is a level for this. For the IMF count, it is approximately 4 months import. For instance, for Turkey, our monthly import is around $15 billion. So you should have, for the robust reserve, you should have at least $60 billion reserve in your central banks to cover your import for the sudden stop for the rest of the world. Okay, but your Nigerian, for instance, United States don't put reserve because their money is reserve currency. They don't have any problem to pay their cash, to pay their debt. But the Nigeria have, but the South Korea, but the South Africa as well, India as well, China, Turkey as well. But the Canada don't, because Canada pay their all obligation with their Canadian dollar. Everybody, rest of the world except. Okay.
Oh yeah. Okay. Thank you so very much. I just wanted to know about it.
I think this is the end of the presentation, and this is the end of the class for today. Thanks for all the participants who joined the class, and hope to see you in the next week, in the next weeks, next months, for the any other interesting topics in financial and real market in macroeconomics.
Thank you so much, Abdulkadir Dogan. Very good, very wonderful presentation. What do you plan to talk about next time?
I think we will decide the issue, but every time I'm trying to get the interesting topics, because lots of people coming from the different backgrounds here, engineers, sociologists, psychologists, and I want to take the interesting issues and topics and charts from different sides, but I think it will be again in financial market. But I couldn't determine the topics right now. I will share it as soon as possible as of today.
Excellent. Well, you are free to go. Thank you so much. I'm going to stay here and answer questions from the students.
Okay, thanks a lot. Have a nice day.
Thank you so much. See you next time.
Bye-bye.